Instead of just making assumptions on what's a better investment or not, deploy capital into both. Active funds and index funds all work. The more diversified you are also, it gives you the confidence to go all out on your business. It gives you confidence also to go all out on other riskier investments. Hey guys, so in this video, I want to talk about which is a better investment, actively managed funds or index funds. And before I answer that, allow me to also set the context that I have both. I'm invested in both because I treat them and I see them as assets that the more I have, the better it will be. That it's nice to make comparisons like this so at least you know the pros, you know the cons, and also you know what you're getting into. But at the end of the day, the more you have of both of them, the better it will be for you. And I'm saying this not out of something I read off a book, but I'm saying this because it actually works. The more assets you have, the better it will be for you. But let me define first to all of you what's the difference. So basically, this applies to any mutual fund that takes in investors' money that pools it to be invested in the equity market. Actively managed funds is you put your money into a fund and each of those funds have their own objectives. But the name of the game for actively managed funds is that you give free rein to the fund managers to be able to decide what stock to buy, how much of that stock they're supposed to buy, when are they supposed to sell it, and how are they supposed to allocate it. It's called actively managed fund because the whole goal and the whole intent of that particular fund is to beat what the index is giving you. So if the index is earning 10%, the whole goal of an actively managed fund is to earn higher than 10%. So for this style, there could be different themes on where the money's headed because each fund, there's an underlying objective on why that fund is formed. That being said, passive fund or index fund investing is you giving your money to the mutual fund, but what the mutual fund is doing, it's merely following, copying the index to the very letter. In the Philippines, we have what we call the Philippine Stock Exchange Index. It's the 30 largest companies in terms of market capitalization, and it's spread across different sectors. You have conglomerates, you have banks, you have property companies, you have mining and oil, and so much more. So if you want to merely mimic what's happening in the Philippine Stock Exchange Index, then passive investing is the way to go. As what I've mentioned earlier, actively managed funds are trying to beat the index.
This video is brought to you by First Metro Asset Management, transforming Filipinos from savers to investors.
When you are investing in an index fund, you are investing in the benchmark. So it's possible that there will be years that actively managed funds will beat index funds, but there will be years also that actively managed funds will underperform compared to the index. So you always think about the index as the average, always think about it as the benchmark. So if you don't want to be disappointed at some years, you just want to be steady, you just want to capture what's actually happening in the Philippine Stock Exchange Index, then the index fund is the way to go. It's a passive way for you to have exposure in the largest companies in the Philippines. And in a way, no, cost-wise, because it's just merely mimicking the index, costs for index funds are relatively cheaper from a broad level. I've studied index funds even up until the 80s. You can always validate it from the charts that it's true that when you invest in an index fund, it's normal for it to go down. Even for active funds, it's normal for it to go down. But what's so interesting about index funds is that when it goes down, it always goes back higher than where it was before. We've seen it drop during the 1997 Asian financial crisis, but we saw it push up once again. In the same way, we've seen it drop the 2008 crash, but we've seen it go up once again. And right here, right now, we're currently seeing it also in the midst of the drop from last year because of the coronavirus pandemic. But if you're a type of person that merely wants to track the index, then by all means, passive investing via index funds are the way to go. But if you trust the fund managers very much, you've seen their track record, you've seen how good they are in terms of how they pick, select, and time stocks. And for a particular season, you've seen them perform very, very well. It might be also a good idea to invest in actively managed funds, especially if you trust the institution of where you're putting your money into. But in my opinion, as what I said at the start, you don't have to actually make them fight eh. What you can do is you can split them. It doesn't have to be equal allocation, but you can actually judge and gauge which is performing well. So what do I mean by that? Say you have 10,000 pesos on a monthly basis that you want to invest in. So what you can do for the first 2 years of your investing is that every single month, 5,000 goes to the index fund and 5,000 goes to the actively managed fund. And then you start to measure it at the end of the second year. Please remember, every time you invest in mutual funds, regardless if they are actively managed or they are index funds, the name of the game, the fund is there to make your money work hard for you so that you can go on with your job, you can go on with your business, you can go on with your career, that you are building a separate asset class that's actually working hard for you. And that's, I think, what's more important. Regardless if you are picking an actively managed fund or an index fund, it gives you the liberty that you don't actually need to watch your stocks, watch your investments on a daily basis. It gives you the liberty that, okay, while I'm doing well with my job, while I'm building my career, while I'm building my business, I have another asset class where I'm putting regular amounts of money that's working hard for me. Then, as you start gauging it in the second year, okay, I think I'm more comfortable in actively managed funds because I like the possibility that it could allow me to earn more than the index. So what do? You don't even have to remove your money in the index fund. What you do is this: extra money or the succeeding amounts that you will get, then you actually put more in an actively managed fund. The same is true in all other investments. You always put more into something that you're more comfortable in. You always put more into something that you believe in. And you always put more into something that you've seen it from your own experience, that it's something that works for you. Please remember, the name of the game for you to be able to make your money grow is conviction. And you cannot take my conviction for investing because that's mine. You cannot take your friend's conviction just because that's your friend. You have to have your own conviction based on what you've researched, based on what you've learned, but also based on what you've experienced, because that's how you can make your money grow. So I challenge you, instead of just making assumptions on what's a better investment or not, deploy capital in both. Active funds and index funds all work. I've been doing it for the past 15 years, that it's something that's worthwhile. It's something that's worth holding on to. And please do remember this. I'm actually saying this from a person who's invested in the stock market, Philippine and US stocks, where I nitpick and decide and I trade on my own. And in the same way, I'm the same person who's investing into cryptocurrencies, which poses a bit more volatility. But I still love index funds. I still love actively managed funds because it's also diversification. Please do remember that the more diversified you are also, it gives you the confidence to go all out on your business. It gives you confidence also to go all out on other riskier investments. So there, I hope that this is something that's insightful, and I hope that this is something that has given you clarity. But at the end of the day, putting in money, doing peso cost averaging also will work. The timeline for actively managed funds and index funds should be long term. The goal for you in order to make it grow is to accumulate. Do not sell both of them for the short term. Use what you have and build it up until you hit your goal. Because if both index funds and actively managed funds can help you meet your goal, then you actually go for it. If you study and go through the mutual funds, you will find out that index fund or actively managed funds, the fund managers take the time to study the stocks and the assets that are being bought. It gives you also the peace of mind that, okay, there will be volatility, okay, there's a chance for it also to go down, but over the long term, what's nice about it compared to picking individual stocks is that there will be no instance that you will be holding into something that will go to zero. That there will be stocks in the index that will go bankrupt and it will still be part of the index. There will be no point also that fund managers would buy companies that are not fundamentally sound. And I think that's what's nice about it. The whole goal of this is for you to be able to have the peace of mind also that if it's not your core competence to invest, to be selective in what stocks to buy, then allow your money to work hard for you by using fund managers to make your money grow. So there, I hope that this was something that's insightful for all of you. And this is Marvin Gurmo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, guys, and God bless you all.
When was the last time you did something for the first time? You remember that feeling of hesitation. Maybe you're not ready. Perhaps you're not good enough. You doubt yourself. It's a long road ahead. And right now you think, safe is a good place to be. You take a step back, but in doing so, you see the whole picture. You remember the stakes you were brave enough to take. So you shout at the unknown no longer, because you are your own master. You rise up, because you know you're not alone. Because you stand on the shoulders of the ones before you. And through them you realize you are more afraid of not trying than failing. They hold your hand, lead you to the peak of your potential. And once on top, you take the leap and do it. The first time you flew and tasted freedom. The first time you went the extra mile and never looked back. The first time you understood that something so small could change the course of your future. The first time you put yourself first. At First Metro Asset, we value you and your achievements. As we navigate through this better normal together, we are here to help you cherish your firsts and make those moments last.